Hi friends, in this video I will present to you a new thing I came up with, or actually I didn't come up with it, but I stole it from great YouTube investor, great investor here on YouTube, Sven Carlin. I strongly recommend you to check out his channel. Great content, one of the best, if not the best, investing YouTuber in my opinion. So I found this risk-reward matrix that he used in his videos and decided actually to apply that to all the stocks I own in my portfolio and that are on my watch list to visually present to you kind of the answer to the question. For example, if I had €1,000 today that I must invest today, where would I invest that money today? So without further ado, let me introduce you to my risk-reward matrix. So friends, here you can see it, my risk-reward matrix. Let me first explain to you what I mean by reward and risk. Firstly, reward is basically my own valuation of the company. How have I evaluated the company? How much money you can expect to make with that company, that stock? Basically, reward is my own valuation here. Then risk obviously relates to the riskiness of the company, in my opinion. How risky I see the company, how risky I see the industry. But in addition, I also calculate in this risk factor the uncertainty of my own valuation. So with some companies, I'm more confident on my valuation than on others. And if for some reason the situation is messy, doing the valuation is more messier than for an average company, I add a little bit risk factor here on this matrix. So as you can see, we have lots of companies, many of which, not many, but a few of them are in my portfolio. Which ones? Well, go and check my last portfolio update video if I forget to mention it in this video. And rest of them are basically companies I have valuation on that are on my watch list. So let's begin with the companies. On the top right corner, you can see what we can call big risk, big reward situations. And let me just quickly cover you everything here. Alibaba, well, lots of videos on my channel on Alibaba, you know the case with it. Geopolitical risk is there, and that is why it is so high up, highest in the risk factor for me. Also, if those geopolitical risks do not materialize, the business is great, so the reward should be pretty good for an investor. Geo Group and Core Civic, you can see both there in the top right corner. Private present operators in United States. They have actually also the political risk aspect to them. Some debt, which make them riskier investments. Core Civic has a little bit of a less debt than Geo Group. That is why Geo Group I perceive to be riskier here. Then uranium. Lots of videos on uranium too in my channel, so if you're more interested in the uranium investment case, go and check it out. It is a risky one, but it's much lower here than Geo Group and Alibaba, and the reason for that is, and as you can see, I labeled it uranium. My investments in uranium are in Sprott Physical Uranium Trust mostly, and also a little bit about uranium ETF. So I have not invested in any uranium company, individual company or companies that would perceive such a risks like, geopolitical risk, as you could have with, for example, Global Atomic, a uranium company that had their operations or their plants in Niger, and there was a coup in Niger, and obviously that changes the investment case quite a lot. The geopolitical, when you look at uranium, countries that produce uranium are some of them in stable legislations and some of them are not so stable countries. So when investing in uranium, you really need to know where your assets are and what kind of geopolitical risks they face. And obviously investing in, for example, uranium operators in Far East or Africa, the risk is bigger, but so is the reward. Investing in, for example, Cameco in Canada, you could say risks are much lower, but most likely the reward will also be lower. This is basic economics, this stuff, and I have chosen as my vehicle to invest in uranium through ETFs and Sprott Physical Uranium Trust, so a little bit less risk here. About the uranium investment case, if that interests you, why I'm so hyped up about it, go and check my videos on my channel and you will know. Then you have there also Flow Traders, a liquidity provider from the Netherlands operating globally. Risk is high, not maybe, well, the industry is financial, so not inside my circle of competence. I'm not feeling too comfortable with this big investment I have. So a little bit added risk there, but overall, when you study the company, the things they are doing are relatively easy to understand in the end, even for a person that is not from the industry itself. So I felt that this is the right place for Flow Traders in my risk-reward matrix. And recently, actually, the stock price has been declining with Flow Traders, and I think I will need to take a look at it. That it could move a little bit up even in this reward matrix if the decline continues. Then Eurofins, again a little bit same situation with Flow Traders. I really like the company. I think I understand the business pretty well. Maybe a little bit better than Flow Traders. That's why risk a little bit more lower. But then again, some things I need to study. Eurofins is a laboratory service provider globally, so obviously their business relates to pretty much to the economy as a whole. Their customer, that they have lots of customers that need their testing services first of all, and one might guess that they are pretty sensitive to what happens in the broader economy. But yeah, in the end, I'm confident that the company can give you great rewards as it has done in the past, big time. One of hugely successful investments for somebody who invested in the company, let's say 10-15 years ago. And I obviously love that the founding person still running the company, founding family owning big share of the shares, big part of the company still. Founder-owned company, you have to love it, because then you know you will have skin in the game by the ones who make the decisions. Moving on, Disney, high on risk because of streaming wars, and that's it. I love Disney. I have video on Disney in my channel. I have owned Disney in the past. Then it went too expensive. I sold it and haven't. That I made my investment before launch of Disney Plus, and that's where I made the money with Disney Plus investment case. But few years moving on, and the streaming wars is fierce. Unclear to me who comes on top of that. Definitely industry Disney needs to be in, but reminds of airline companies which struggle with profitability all the time. Airline companies, in my opinion, bad industry to invest in. I have fears that streaming services could be similar to airline companies. Still, Disney has also their amusement parks and cruise lines, which are amazing businesses. Portfolio of brands Disney has, amazing in my opinion. I am really tempted to come back as a Disney investor. Maybe if I would see now the stock in $70, it's now somewhere 80. $10 down still, and I really consider becoming a Disney shareholder again myself. Then let's move down to the right bottom corner, and obviously now you see my matrix is kind of funny in this sense that this is the quadrant where you want to see the companies you own. You want to have a great reward moving on the right side, but you will want to have them with low risk, so moving down in my matrix. And here I have to tackle my newest position in my portfolio, Amsterdam Commodities, holding company that trades spices, tea, herbs, what you have it there. Go and check all in depth. I talk about them in my last video on the channel. It's a niche operator in food industry, something I really like, and I think maybe presents at the moment the best risk-reward case in my opinion out of all of these stocks maybe. And overall, I have my biggest positions Alibaba, Uranium, and Flow Traders. They're up on the risky side. I would like to bring my portfolio more down here to the lower risk, higher reward side, a little bit more Warren Buffett style investing. When I was younger, a few years back, I went with the big risk operators. In the past, had a big position in Alibaba and still do, but lately I have been becoming maybe a little bit more conservative myself and would like to see a bigger part of my portfolio here in the bottom right corner. And that's where my attention is at the moment, to rebalance a little bit my portfolio this way, to this side of this matrix. But yes, Amsterdam Commodities, go and check out my latest video, you know what the company is about. Niche operator in the food industry. Another food company that I own, Tyson Foods, biggest meat company in the United States. Present, in my opinion, pretty low risk investment with okay returns ahead, okay rewards ahead. By the way, all the companies in my portfolio, you can find all videos on my channel. So if you're interested in any of these, actually, all the companies I have in my portfolio, you will find a video, and then also additionally some of these I don't have in portfolio. Tyson Foods I have, and Carriage Services there next I do have. Funeral home business, cemetery operator. You can see Carriage Services there presenting pretty good risk reward case at the current levels, current stock prices in my opinion. And additionally, right beneath it is a little bit more little bit more expensive company from the same industry, Park Lawn Corporation. And when you move left to the lower risk bottom left quadrant, you can see Service Corporation International, which again is competitor of Carriage Services and Park Lawn Corporation. This is when I did my study on funeral homes and cemetery operators in the United States, I came across all of these three. Carriage Services is in my portfolio. There are rumors that Park Lawn Corporation would like to buy Carriage Services, and the stock price saw big jump recently, but then it came back down after the news when nothing happened. So we will see if Carriage Services gets acquired by Park Lawn Corporation. Obviously, as an industry, funeral home, cemetery operators, I perceive really low risk, something you would like to own in your portfolio when the valuation is right. Unfortunately, in the world, people keep dying all the time. That is a certainty that will happen, unfortunately, but this is how world works. So these companies, unfortunately, always will have business. And in the industry, in the United States, the funeral home, cemetery operators are hugely fragmented industry still, even though there are these big companies operating. Lots of the companies are also family businesses, small businesses in the United States, and there is an aspect of consolidation in the industry, which I like myself. When I see consolidation happening, that means that when smaller players get acquired or just quit their operations, it gives a chance for the bigger corporations to lift up their prices and make their business with better profit, better margins. So that is the consolidation aspect I find myself liking, and this is what you can see happening in funeral home and cemetery operators. Then, moving on, now we go to the left side of the whole matrix, which means basically you can make a divide here that I see pretty good buys on the right side of the reward matrix, on the right side of the matrix. These are companies I could consider buying, but everything moving left here I perceive to be overvalued at the moment with varying degrees. So first of all, we have their approaching actually fair valuation, in my opinion, Lockheed Martin and General Dynamics, military companies from United States. We all know what is happening, unfortunately, in the world, in Ukraine at the moment. These companies, arms industry saw big jumps, obviously, when a war breaks out in the world. That's natural. They have come down since the stock prices of these two companies. Unfortunately, I am from Finland myself, so I know that we have an unfortunate neighbor in our eastern border that will keep these companies busy in their businesses, unfortunately. This is something you must do, defend your country. That's the number one priority of any country, and you will invest lots of money in that one, and these two companies stand to benefit from it, obviously. Investment case pretty simple, then it's all about the valuation. Moving upwards from Lockheed Martin and General Dynamics, Intel, medium position in my company, but not anymore since Friday. I can update you now. In this video, I have sold out of Intel completely. As you can see, Intel stock price moved upwards. I have been owning Intel for quite a long time and actually updated my valuation downwards in my last Intel update, if I recall correctly. First valuation when I bought Intel for the first time, it was a little bit above, somewhere around $40 when I first bought it, I think. Then I added a little bit when Intel broke down. No, I can't even remember where, probably. If I'm not, I can't remember, but probably somewhere around $30 I added more of it. Excuse me. And then I was able to dollar cost average down, but now I end up selling actually probably like 4%, 3%, 5%, something like that. I took a small loss with Intel, and the reason mainly was that as with my updated valuation, I saw Intel actually becoming fairly valued, and the risks, and when the price goes up, the risks go up too. The company has quite a lot of debt. That's one reason for the risk. I needed also cash to my portfolio. I wasn't happy with the cash level I had, and when I had a chance to sell one of these companies and get some cash to my portfolio, now Intel was the one I sold, and now I have cash, and now I'm actually more prepared for any shocks to the market downwards. And to a little bit add, in addition, I feel some companies here actually that are pretty close to each other in my matrix. Let me say Lockheed Martin, General Dynamics, Intel, and Alphabet, for example. These, I think, are companies that US government perceives really important. They are matter of national security in some sense, all of them. Of course, Lockheed Martin and General Dynamics probably more than these two. Intel actually, I feel, is really important for also US government. So I find myself liking these kind of companies that I know have license to operate by the countries they operate at, in this case United States, mainly United States. I would consider entering back to Intel. Let's say if the stock price comes down to $30 again, Intel is in my radar definitely to buy more of it. Moving on. I also touched already a little bit on Alphabet there. I have videos on Alphabet, great company, great balance sheet and everything. Just now moving to this, let's tackle all these three together actually here. The lowest risk companies here on my list are Alphabet, Berkshire Hathaway and Microsoft. These are amazing companies. This doesn't come as a surprise to anyone. Companies I would love to own, lowest risk companies I can come up with. The matter of the fact just is that in my valuations, they are overvalued, as is big tech in my opinion in the United States. I have sold out of Alphabet, used to own that not too long ago, not anymore in my portfolio. Same thing with Intel actually, you can find that company in Standard & Poor's 500 too. Intel, obviously, I think catched some tailwinds with the Nvidia mania happening. That might be the reason actually why their share price went up and I was able to sell it. But coming back to Alphabet, great company. Coming back to all of these three, Alphabet, Berkshire Hathaway, Microsoft, these are the greatest companies of the world, lowest risk in my opinion, but just overvalued at the moment. Berkshire Hathaway is a financial fortress. Microsoft has, with their products, the best stickiness of any companies I can know with everything they own. They're such a big moat companies. If there are shocks to market, these are the first ones I want to buy in my portfolio. But as things stand, simply the big companies of the United States, I just feel are overvalued at the moment. And This is the only reason why I don't have any of these three in my portfolio. But once the chance presents itself to have them in my portfolio, I will definitely jump to that train immediately. It's all about valuation. Well, Service Corporation we already talked about. Maybe not just that I think they are much more overvalued than Carriage Services and Park Lawn Corporation. They're smaller competitors. Starbucks, another big moat business in my opinion, simply too expensive. Meta, well, I'm sure you, my viewers, know that I owned Meta. I doubled my position when it approached $100. First buy I made at 170 and then I sold all at 180. Took nice profits there pretty quickly. Obviously the stock price went much higher, but that was too much of speculation for me, so I'm happy with the profits I took out of the company. At $100 and even beneath, Meta was a great buy, and my only regret is that I didn't buy more of it when I knew every metric I have where was flashing red that this company is a great buy at the moment. I should have gone in bigger at the time. That's the only regret that's the only thing I regret, is that I didn't put bigger amount of money in Meta when it was somewhere around $100. But still made nice profits with it, and that's the story. Now I just feel that the company is overvalued at the moment. Again, maybe due to the social media where the company operates more than Alphabet, Berkshire, or due to social media being their industry, unlike Alphabet, Berkshire Hathaway, Microsoft, I feel the risk profile, it is a riskier company to invest in, but still a company I would love to own again in my portfolio. And for some reason, the Meta stock price is always crazy. People are so jumpy on Meta that I think I will get a chance to own Meta once again. Maybe not. I don't know. Now the stock price is too high for me, too high of a valuation. So let's see what happens with the company in the future. Then we have the worst company on the list, maybe in the reward side on valuation side. Manchester United. You can find some football videos and football/investing videos on my channel. So if you are a person who likes football and investing, go and check out those videos from my channel. Manchester United obviously has been the target of buyouts. There are different people wanting to buy the whole club from the Glazer family. That is why the stock price, in my opinion, has seen such a run up recently. The situation is messy. Nobody really knows what happens with the football club now, I don't think. But the matter of the fact is that I think it's hugely overvalued, and I wouldn't even consider it in my portfolio. But I must say that the one thing that could change the whole investment case with football clubs, with Manchester United being the only listed company from England, could be change of financial fair play rules to a way that makes football club operating much more profitable than it is now. At the moment, operating this big club is everything but profitable, and that's how it has been throughout the recent history. Football is a terrible industry to invest in, unless you are Ryan Reynolds investing in Wrexham and making huge money with it. That's the exception that that really solidifies the law here, or I don't know how do you say that thing in English, but Wrexham is the exception. But I think there's the aspect of buying a smaller club is totally different from buying a Manchester United, and not all of us are Ryan Reynolds, so that's the story of it. But Wrexham, what a wonderful story in my opinion. It is absolutely amazing to see somebody actually making huge profits with football. Amazing stuff. Really respect the guy. But yeah, Manchester United terribly overvalued at the moment. As financial fair play rules are as they are today, I don't think I will, even though I'm a huge football fan myself, I don't think I'll be owning a football club anytime soon, unless something happens with UEFA in Europe and football takes a step closer to how professional sports are operated in the North America, United States. That could change the whole thing up, but I don't think we're gonna see that happening with Saudi Arabia buying all the players and stuff. well, this seems like a topic for another video, so let's continue with that later. We have Harvia there, Finnish sauna company, makes saunas, very Finnish company in that sense, hyped up stock, and that is why I think it's still overvalued, even though it has first crashed from the Corona mania highs quite a lot. As said, still feel the company is really overvalued. Maybe due to the fact that it's so hyped up stock among Finnish investors, and I think that kind of ruins the case for it. I am not the one personally investing in hyped up companies myself. From the risk side, they will be probably fine when things settle, when the dust settles down at the current market situation. But I just think how people talk about their having the best brand and stuff like that, I'm not fully buying into the story myself. I think the company is overvalued still. So that's that. Then we have the last quadrant left here. These are relatively high-risk companies that I think present bad reward cases at the moment because their valuations are too high. Crocs, a company that I owned. I bought it when it was really cheap and sold it when I think, did I buy it in $40, $45 and sold it at $70 in 3 months, made good profit really quickly with the company. When it was at $45, it was a total bargain in my opinion. There was bad news around the company. They acquired Hey Dude and they have too much debt and they have everything going bad for them. But then when the news sentiment changed, they were suddenly back the company stock price again in $120 and everything seemed rosy again. Now coming back down in the Crocs, so I'm paying attention to it. It's a retailer, it's fashion, retail industry, fashion are risky industries. That's why it is high on the risk profile and it should be high. But then again, the best buys sometimes are those that seem risky and news sentiment is really bad and everything is going bad for the company, even though in fact it isn't going bad. That's when you can find great opportunities. With Crocs, I found great opportunity back in the days, looking for the next story. So I'm paying attention to the situation. And obviously, even though their shoes are ugly, some people say it's a brand, it's a strong brand in my opinion, and they definitely are doing something right in the company. So at the right price, it's a bargain, as it was back when I bought it last time. Well, then I have here Tesla and Spotify. I think it's not too many videos ago that I really tried to say to you, my viewers, that I don't think these are bad companies by no means. They are great companies producing great products, both of them, Tesla and Spotify. Spotify is really important for me. I subscribe to it monthly. Extremely sticky product, but even these are cases, both of these, Tesla and Spotify, these are the cases where you have great products, but you know that that's only 50% of the story, that you have a great company doing great products. The other 50% is the valuation. What am I as an investor going to pay for these, the stock of these companies? And as you can see, in my opinion, Spotify and Tesla are really overvalued in today still. Wouldn't even consider myself investing in them. Spotify seems to have also problems with stock-based compensation or such that I think I remember reading a blog where it said something that it seems like the company is run for the employees and people working at the company and not for the shareholders, which is obviously something you as a shareholder don't want to see. So if I were to invest in Spotify, I would need to research this stuff more, that my money is not going to the employees as an investor, but I actually could make profit with this company someday. Well, the valuation I got from Spotify is so high that I'm not looking more deeply into it now. I want to see it crash before I do that. Tesla, well, there is a video on Tesla on my channel. Go and check it out. I made a valuation on it, and when Tesla stock price was crashing, I actually gave you even my valuation when I will become a Tesla shareholder myself. I had the number there. Tesla never dropped that down, so I never became Tesla shareholder. But even though some people who have been watching my channel would say that I'm a Tesla bear or something like that. I am not. I just think the company is chronically overvalued, it still is. But mark my words when I say that I want to own companies producing great products, and Tesla and Spotify are two of those companies. Well, this was my risk-reward matrix inspired by great Sven Carlin here on YouTube. Go and check out his YouTube channel. Overall, what I can say now that this risk-reward matrix for me is a nice visual illustration on if I needed to invest 1,000 euros today, where would I invest it? I already told you to summarize this lengthy video here. To summarize, I think I want to move, as said, 3 of my biggest positions are Alibaba, Uranium, and Flow Traders. And when you put Core Civic and Geo Group together, they are my 4th biggest position. So I'm high on the risk side, I know that myself. This is why I want to become in the future more a little bit like Warren Buffett style investor with, you know, buying great companies with good prices and maybe not good companies with low prices, as might be the case in some of these, at least Core Civic and Geo Group, somebody could describe as Benjamin Graham style cigar butt stocks. Not the stuff Warren Buffett is doing nowadays. But as said, I want to bring my portfolio down on the risk, still keep the high reward though, but a little bit I'm willing to sacrifice on the reward side to get the risk down. Today, if I needed to add to some of my positions, as said, Flow Trader stock price is dropping, so I'm paying attention to it. Should I add Flow Traders? But most likely Amsterdam Commodities would be the company I would invest 1,000 euros today if I needed to make a choice today, which I don't, because I don't need to invest my cash. I can decide any day I want to invest in it. And as I told you, with selling of Intel stock out of my portfolio, now I have a good amount of cash to use. If some shock hits the market or stuff, I wanted to have that in cash, and now I have it. But I think Amsterdam Commodities, Tyson Foods present pretty good investment cases with the lower risk side, Carriage Services too. I would look at those 3 myself currently if the stock prices stand as they stand today. Other interesting companies to invest in would be, let's see what kind of shocks Disney might have, how low the stock price can get. Can it get oversold? I'm sensing that it might happen with Disney, paying attention to it. Alibaba, my biggest position, I'm not comfortable at the moment adding to my position more. I want to keep it as it is. Same thing probably goes with Core Civic and Geo Group. Maybe Uranium too. I don't want to add that risk anymore. So that is why my buys today would be there in the lower risk, okay reward side. Hey, this was the first time I did this kind of risk reward matrix. This video was pretty lengthy. Let me know if you want me to make these kind of videos again. Thank you for watching this video. Subscribe to the channel if you like the content, and I see you in the next video. Bye bye.